Well, we're going to talk to the MD of Collins Street Asset Management, Michael Goldberg, about value investing. That's the main topic, but we also want to know what his fund and his business actually does. Mike, thanks for joining us.
Thanks for having me, Peter. Appreciate it.
So tell us about Collins Street Asset Management.
So Collins Street Asset Management is the management company of the fund that we run. The fund that we run is called Collins Street Value Fund.
Okay.
As the name would suggest, we are a value-focused fund manager. We've been going since 2016 when we opened for our first investors, and we've done quite well over the journey. We had our 5-year anniversary this month, and we're able to match it up with a pretty good ranking in the Mercer surveys and pretty good results.
That's good. And a lot of people don't really understand value investing. So why don't you do your best to explain?
Look, I'm not surprised that people don't understand value investing,
Yeah.
because value investing means many different things to different people. Yeah, now if you look at the doyen of value investing nowadays, everyone thinks of Warren Buffett, but of course the Warren Buffett of 50 years ago is quite different to the Warren Buffett of today.
Yeah.
So the way I think about it really is there's probably a spectrum, and the two fathers that I imagine of value investing is Ben Graham, which was Warren Buffett's teacher, and a fellow named Philip Fisher, who was the first to really come up with like fundamental analysis and ascribing value to an operating business, which is a little bit different to where Ben Graham sat, which was let's work out what the fire sale value of these assets are, and on that basis it's either cheap or it's not.
Yeah.
So I think you'll find across that spectrum, you'll find all of the different value investors and growth investors sitting somewhere along that spectrum.
Yeah.
For me, we're looking for companies that we have the capacity to understand. We're not looking for companies that are complicated and, if I can't understand it, I can't invest in it. We're looking for companies that have some sort of advantage, so that they've got that moat that value investors tend to talk about, something that protects them from their competitors. We're looking for good management, because if you've got bad management, it doesn't matter what's happening with the rest of the company, you can lose your money. And we're essentially looking for a company at the right price. Basically we want to find a business or an asset that we think that's worth $1, where we can buy it for 50 cents. And that's at the heart of value investing, what it is, buying $1 for 50 cents.
So some people who are in this space talk about the intrinsic value of a company, and that's what you're really looking for.
Exactly.
And if that intrinsic value is, say, $5, but the market says they don't like the company at the moment, and they're saying they're only paying $3, you say that's a company we're going to go for.
Absolutely.
But does it mean then that there's no specific kind of company that is a value company? Like a growth company could be a value investing target if the market just treats it really badly.
Yeah, 100%. And the truth is, had you asked me 10 years ago when I started off professionally, that was more like 15 years ago, but had you asked me early on, what sorts of companies can be value investing companies, I would have said, we really focus just on industrial companies, because you can get a sense of what the earnings are, you can get a sense of what their outlook is going to be, and on that basis you can work out what
history's there, isn't it?
Correct. But the truth is, you can find value in biotech, you can find value in technology, you can even find value in commodities. Now, again, I imagine that most people who say that they use value investing as their approach to investing will tend to stay away from commodity stocks and tend to stay away from technology stocks, because that's not their area of expertise. And being able to understand what you're investing in is the key number one most important thing if you're a value investor. But certainly you can find value ideas just about anywhere.
Yeah. And so I guess your skill has to be to look at a company, go through all their financials, and then also understand the business and where the industry is going. Put all these things together and say, hang on, the market has totally got this company wrong.
Yeah, it's not easy to do that, right?
No, it's not.
Emotionally, if you're buying, let's call it company ABC, and you think it's worth $5, and it's trading at $3, and then it goes down to $2.50, and then down to $2, and then down to $1. Well, if all you've got to work out if you're right, or if the only basis for whether you're correct or not correct is what the share price is doing, well then it's panic stations, right? You've halved your money, you feel like I've got this wrong, it's time to move on. But if you're a legitimate fundamental investor and you're looking at the actual business, and the business goes from, you think it's worth 5, it's trading at 3, and then it goes down to 1, like that's not a scary thing. That's an opportunity to buy more of the company that you like at a cheaper price. Now again, it's all well and good to say that, but there's a ton of effort that goes into the process to make sure that you actually understand this business. I'll give you an example if we've got the time
go for it.
So one of the earlier stocks that we looked at for the fund was a company called Metcash. They essentially run IGAs. They have other businesses, but historically their fortunes have been born out of the success of IGA or otherwise.
Oh, the old David Holdings company.
Yeah. So
that was before you were born.
It was before my time.
Yeah.
So when we looked at it about 5 years ago, the brokerage world, the institutional investors, hated it. They said, you cannot, the model is broken, you can't run supermarkets as a franchise model. It just doesn't work.
Yeah.
And I'm sitting there across from my co-founder Vas, and we're sitting there having a think, and we've read the announcements from the company, and we think we've got a pretty good sense of what their plans are. Essentially they had 3 plans. They said, number one, the market thinks that IGA is always expensive, so let's price match. So the number one initiative, they were going to price match against Coles and Woolworths. Number two, they have some amazing IGAs, and they've got some less amazing IGAs. So they made 2 offers. Number one, they were going to retrain to best practices all of the IGAs that needed help.
Yep.
And number two, they were going to gift the stores on a 50-50 basis for any refurb the store did. So if the store said, I'm going to put in $100,000, Metcash said, I will give you, not lend you, give you $100,000 to match so you can do the job properly.
Yep.
So those things sounded like reasonable things to do, reasonable ways to turn around the business.
You also missed the fact that they hired me to talk to the annual conference about improving customer services. That
explains it. That was the missing
key.
Yeah,
that was the
if only the rest of the market realised that.
Yeah.
So we're sitting there across the desk from each other, and we understand why the market doesn't like it. We always like to understand.
And it's competing against Coles and Woolworths, for God's sake.
Yeah, the behemoths.
And then the Aldi had come in as well, so it was a tough
There
market.
were a lot of headwinds, supposedly.
Yeah.
So we're sitting there and we're having the conversation over the table, and I'm saying, how do we work out? Is the market right? Is the system broken? Is it impossible for them to make money? Or is what management's saying going to work, and is it going to pan out? So we called up management, we had a chat, and you've always got to be a little bit cautious when you speak to management. You want to make sure that they're excited about what they're talking about. It's more about how they tell a story rather than the story they tell, because they're pretty good at telling stories normally. But we sort of got comfortable with our understanding of what he was trying to achieve.
Yeah.
But what caught us, and what we found was especially interesting, was he wasn't saying that this is going to happen in the future. He was saying we've already implemented these processes on a pilot basis across many, many stores around Victoria and New South Wales, and it's working. And if the market just waits 9 to 12 months, they'll see the results. So that was an interesting thing for us, because all of a sudden we're not just trying to speculate, is the stock price going to go up or is the stock price going to go down? He's telling us that there's evidence that this thing is working. So I looked at Vas, I said, we've got to go on a road trip. He said, what do you mean? I said, well, we can't know for a fact whether he's telling the truth, and we can't know if the market's right. Let's go out, spend a couple of days on the road, and visit IGAs to find out if, since they've implemented these processes, whether it's making a difference to their sales and their profitability.
Yeah.
So keeping in mind, IGA is a franchise model. So
mums
and dads, different sorts of people.
Yeah.
So I don't know what we were thinking, but we've done it since, because it tends to work out. We just started turning up to IGAs unannounced.
Yeah.
We'd go to the checkout person and say, can you please point us to the manager's desk? Yeah. And they point us to the manager, and we'd go have a chat. And we'd schmooze to this guy for, all these people for half an hour, whatever, and get a sense of how the business is going. So one of the first stores we walked into was a lovely store, and the manager was on his call with the rest of his network, because a lot of owners actually own a few stores, especially the really good ones. And he was sort of half talking to us and half talking to the morning conference call. Yeah. And at one point, he turned his screen to us and showed us the trajectory of sales since they'd implemented these processes. Oh my goodness, Another time we met.
Eureka moment, wasn't it?
Well, it's no longer is it working or is it not working. Yeah. Now we're getting a sense. Well, one swallow doesn't make a summer, but it was certainly the start of an interesting conversation with a lot of other people. All of a sudden, we're not trying to work out is it working or is it not working. We just need to work out what's the benefit. How much is this worth to the company? Another store we visited, again a lovely store. We ended up talking at the bottom of a staircase underneath the in-store pizzeria. We spoke to the son of the.
That innovation in IGA stores is actually very interesting, isn't it? Because there's an Italian IGA at Haberfield, which is one of the best Italian delicatessens you've ever seen. Yep. And that innovation suited that audience there. The Italians do.
100%, and they've always catered to the community. That's been they've been the community supermarket. That's been that's been their selling point. But now they're introducing these other things. So the feedback was sensational, and it wasn't just that it was working for them, but apparently, as you know from what you said, they have these biannual conferences. I think the one just before our visits were in Queensland, and
that's the one I went to.
That's the one you went to.
Surface Paradise.
Well, Thank you very much for the profits we made on that. But the people we're speaking to were saying not only is it working for us, but the feedback across the whole network is so positive that even though management were planning an 18-month rollout, they thought it would be out in 6 months.
Yeah.
So we went home and said, you know what? Looks pretty good. You know, we've got a good sense of what the earnings are going to be. Let's start buying it. $1.60, down to $1.50, down to $1.40, down to 90 cents. Yeah. And as I said, if all you've got to measure whether you're right or wrong is a share price, you'd be getting pretty nervous, right? But if you can get that, what we call a information advantage, well, if I liked it at $1.60, I'm going to love it at 90 cents. Yeah. And that's the approach we take, where we can put in the extra effort, just be that little bit more uncomfortable than the next guy, just put in that little bit extra effort than the next guy. Yeah. There are tremendous advantages and benefits to just doing that little bit extra. Yeah. Now, the risk is people feel uncomfortable walking into supermarkets, and we did get escorted out of one of the...
And we're wearing ties and suits and stuff like that.
Yeah, look, we went in dressed appropriately for fund managers. Yeah. We introduced ourselves, we handed out our card. Right. But there was one manager who thought perhaps we were a competitor and looking to spy on their progress. And
they've seen those American movies where that sort of thing happens.
That's it. So we got escorted out. It was funny. We sat in the car and I turned to Vass, who's grinning from ear to ear. And I'm a bit shook, I'm not really that confrontational. Yeah? The biggest confrontation I had in my house was who gets the last schnitzel on the dinner table, yeah?
I turned it's a big issue, big issue.
Schnitzel's important. I said to Vass, why are you grinning? He said, Michael, until now, everyone said the same thing, it's been a boring story. Now that we've been kicked out of store, that's a story we can tell. I said, way to see the silver lining.
All right, so that's the IGA story. And I think you've basically covered a lot of the advantages and disadvantages of value investing. But are there other aspects of what you do that does give you a competitive edge, and therefore it then shows up in your returns?
Yeah, look, I think there are probably a lot of fund managers who will make that extra effort, and a lot of them have been getting fantastic results. I think one advantage that we have is the mandate that our investors have granted us. They're not interested in us building a 50 or 100 position portfolio. What they really want from us is just to buy into our 10 to 20 favorite ideas. Yeah. And as Warren Buffett often says, why would you put money into your 20th best idea when you can put more money in your first or second or third best idea?
It's a good point.
So again, I'm not sure that our process is that different to many of the other fund managers out there, especially in value world. I think the key advantage we have is that our investors have allowed us to really just focus on our favorite ideas, put our focus on those favorite ideas, and when we find a company we like, we buy enough such that it can have an impact on our portfolio.
And because you're not listed, it means you're not being affected by the whims of the stock market all the time. I think that's an advantage. But secondly, I presume your investors don't expect you to do great things in 3 months, like a lot of listed fund managers have to do. If you invested in Metcash and it takes 6 months for it to come good, well, are your investors a little bit more tolerant of that kind of thing?
I think the answer is yes.
Yeah. But not always.
I was going to say, I think it's a step too far to suggest that just because we're unlisted, people don't expect immediate returns. People always want more than what you did last time. They always want to see better results and better results. And look, that's part of the challenge of being an investor in general. You've got to know what your limitations are. Yeah. We can't be chasing the next exciting tech stock. Somebody sent me an invitation to invest in a quantum computing software or hardware. Yeah. I said, well, it sounds interesting, but for the life of me, I can't understand it. Yeah. Do I punt on it because I'm chasing the returns from the tech space, or do I just stick to my knitting and keep doing what we've been doing? And of course, the important thing is, at least from my perspective, is stick to what you know. If it's working, if the process is working, if the spaces you're investing in are giving you the results that you need, why would you risk capital on things just to get a better result?
All right. Now, one thing I noticed that over the 10 or 11 years I did the Sky Business Program was a lot of really well-known and very successful value fund managers did fantastically well after the GFC because the market had just ridiculously mistreated a whole lot of companies. Yep. And therefore, we noticed that after the coronavirus crash, the same sort of things happened. Does it become harder as we get towards the end of a cycle for a value investor to find really good value because the market has just chased everything?
Yeah, look, the answer is yes, it definitely becomes harder. There are still rocks that are not, that are unturned. There are still sectors that the market might be uncomfortable investing in, and so you haven't got the coverage that you need. we had concerns about the market in 2017. We thought property prices were getting expensive. We've been thoroughly wrong on that.
Yeah, well, should have been reading me, mate. I was telling you not to worry about it. But go on, anyway.
Sorry. Again, in 2019, we started getting concerned that markets were getting expensive, and we didn't call COVID-19.
No.
I'm not going to claim that we did,
No.
but going into COVID-19, because the markets were expensive, we'd accumulated cash, and so we had about 35% cash, and then when the opportunities presented themselves, we were able to take advantage.
You must have loved that.
Oh, mate. Rob, Vass, the whole team, whenever the markets go up, they look at me and they say, Michael, what's wrong? And I said, the markets are going up. It's making my job harder. But be happy, the value of your portfolio is going up. I said, yeah, I'm happy about that. But, my job is to invest capital.
Yeah.
So look, I don't mind a bit of opportunity, a bit of challenging periods. Yeah. But certainly when you get these uncertain periods, when you get these volatile markets, that is when the opportunities really present.
Okay, Michael, we know that the first phase of this uptick in the stock market has been stay-at-home stocks, tech stocks, and we know there's a rotation into the reopening trade going on. Now that means that there's still a lot of really good companies, and let me give you an example of one that we invested was Webjet.
Yep.
At $3, I thought, that as long as they survive, and there's always a possibility they wouldn't, but $3 it seemed good. Now it's around 5 or 6, and I figure there's going to be another leg up for them 6 months, 9 months, or even 12 months down the track. Is that going to be the group of companies that value investors like you look for, those reopening trade type companies that were smashed because they weren't stay-at-home stocks, and they're the ones that still offer a lot of value going forward?
I understand what you're saying, but I think it's a bit the opposite. I mean, those were the sorts of stocks we were looking to invest in when they were down at $3. Now they're at $5. You've got to wonder, what's the future look like? What I find is there's really two stages to an investment, just internally, the way I feel about it. There's a stage where you find something where you just know, like just objectively, the feel the air test, this thing is ridiculously cheap.
Yeah.
When Webjet did their capital raising, if we figured if they could raise enough money to get through to the end of COVID, whenever that was going to be, this would be ridiculously cheap. Yeah. So what was it, $1.60 or something was the capital raising?
Yeah, I think so. And it was oversubscribed.
Correct. We subscribed and got nothing. Yeah. Even at $2.50, you're still in that space where it's like, okay, this is ridiculously cheap. Now, I haven't really followed Webjet that closely since, and I don't have at the tip of my mind what their earnings profile looks like going forwards. But it's one thing to say, okay, invest in it at $2 or $3. It's another thing altogether to say at $5. Now, if it is still cheap, and I'd have to do the assessment, then yeah, it doesn't matter that it went from $1.50 or $2 to $5.
Yeah.
It matters what's it going to be next year.
Yeah.
But I would suggest that most value investors would have got set in those sorts of stocks while they were unloved. I mean, that's when you make the money, right? When you invest in these unloved companies. Once they're loved, it's time to think about maybe moving on.
Okay, so I've led you in the direction I wanted to go.
Okay.
What about some of your favourite stocks that you do like right now?
You're asking if I'm emotionally attached to any of my companies?
Well, maybe stocks that you've recently purchased that you still think looks like good value.
Yeah. I think probably one of the most interesting things that we've invested in recently, although we did start back in 2018, was a group of uranium companies.
Okay.
We got a phone call from, I think it was Bell Potter, trying to tell us about the latest and greatest technology company. And again, Vass and I, we sit across from each other on just a big open office plan. I could see he wasn't interested in what he was being sold. So I wrote him a little note and I said, Vass, ask him what he's really interested in, what he's really excited about, but he's embarrassed to tell his clients because it's too out of left field.
Yeah.
So he asked the question, and the guy says, have you ever looked at uranium? And again, our initial thought was, uranium, we're not going to, commodities, value investing.
And it's unpopular in the politically correct generation.
But exactly. People are still concerned from 3 Mile Island, from Fukushima, from Chernobyl. It's a scary thing to think about.
It's a scary thing.
Yeah. So he said, uranium. So, Vass said, can you send me some information on it? And we started the research, and, we discovered it was one of those Webjet at $1.50 moments. The spot price was trading at about $18 per pound. The global leaders in the space, both in Kazakhstan and in Canada, had cut production by 20%, and the spot price went from $18 to $19 against a global average cost of production of $45. Yeah. Now, when I ask people, what do you think the demand side of uranium is? What proportion of the US grid or the global grid do you think is powered by uranium? most people tend to significantly underguess. 11% of the global grid is reliant on nuclear energy.
Yeah,
25% of the US grid is dependent on
I guess the Simpsons told us that because Mr. Burns ran a very, very successful nuclear power generation.
He knew what he was doing, although we might have had a few more Chernobyls if we had Mr. Burns in charge.
Exactly.
Certainly if we had some Homers in charge. So we did our research and we discovered there was this massive undersupply issue that was coming down the pipeline because US utilities, due to a number of political issues, weren't coming back into the market, and the US utilities are by far the biggest buyers. So we said, you know what, we've seen coal prices fall below cost of production, and we said we're not going to touch it because value investors don't invest in commodities. We saw oil prices fall below the cost of production. We said, you know what, forget about it. We don't invest in oil. You know, third time's a charm. We said, you know what, let's be a bit more sophisticated. Let's do our research. Let's take a proper look at this. Again, can we buy $1 worth of value for 50 cents? And we discovered that we very much could. Now, we didn't go in and back a single company. What we ended up doing was backing a number of companies to give us some diversity of exposure around the globe in terms of, you know, where they're up to in production, how quickly they can come back on. You know, the overlaying theme across all of them is, again, it's got to be good management. We're looking for low cost of production, and we're looking for good jurisdiction. So those are like really the three key things. So our main positions at the moment are probably Paladin, which is the major player, tier 1 asset, fantastic business. Peninsula, which is a smaller company, much smaller company, listed in Australia, but with their operations out of Wyoming in the USA. So again, very interesting. There's some political machinations going on over there that suggest that perhaps there could be some special benefit to them being US based. And the third one is probably Boss, which is an Australian-based company. I think it's one of only 3 or 4 permitted miners to dig it up and export it. Obviously, there's no local nuclear industry, so it's all exported. Again, great management, excellent jurisdiction, being in Australia, and also a low-cost producer. So we sort of gave ourselves exposure to Africa, to the States, to America, to Australia, to give us that broader exposure. Now, you know, our timing was awful. We bought it in 2018, and even though spot price went from $18 to about $30 in late 20.
But you needed to go to 45 at least.
Well, you do, for starters. That's for starters.
Right.
But share prices in the Aussie listed companies did absolutely nothing. They probably even went backwards a little bit. And again, it goes back to the same thing we were talking about before. If all you've got to judge whether you're right or wrong is what the share prices are doing, well then, you know, maybe it's time to go to panic. But we're confident in our thesis. You know, we've done the research that we can. We sent Vass off to Wyoming, where he got a bit of a cultural lesson in the Wild West, and you know, shooting and big cars.
This is Vass, is it?
Vass is mine.
So he copped a lesson at the IGA stores and also in Texas.
Well, he was laughing at the IGA stores, so it was me that copped the lesson at the IGA stores. He got the free trip to the United States. Right. Yeah, so it was a good deal.
So all of this, Michael, what was it done in terms of your returns, and over what kind of time frame?
From 18 to mid-20, it did nothing. From when it started to go forwards in about 6 months ago until about now, it's probably accounted for about a third to a half of our returns, about 15% over the last six-ish, nine-ish months.
Okay, so if you look at a per annum basis since the time you started, what does the fund manage to return?
To the end of last month, we're running at around about 17.75% per annum after fees to our investors, which is fantastic. Look, it's been buoyed by COVID. Again, we always say uncertainty provides for opportunity, and there was certainly a lot of uncertainty in COVID-19. Our returns for COVID-19 for 2020 was 33% to our investors, so that's going to obviously buoy our average across across the spectrum. But even before COVID, we were running at around about 15%. Net for our
and I guess a lot of people would be interested in your view on, we're still not past where we were on index-wise, the level of the ASX 200. We're getting close. Do you think, because of all the unusual things that have happened since coronavirus, like an unbelievable level of stimulus, an unbelievable level of low interest rates, this is the sort of stuff that you and I have never ever invested in or thought about, do you think that means that the likelihood that the stock market is going to have a good couple of years seems highly likely?
Look,
and be right too.
I'll be right. Okay, fine. Can I hedge my bets one each way?
Yeah. On the other hand, you can say on the other.
Well, look, if you look at the market as a whole, and I don't really like to look at the market as a whole.
No, because
we prefer to look at it as like a market of stocks rather than a stock market, because we're very bottom up. We're looking for those unique opportunities that are mispriced. But if you look at the market as a whole, certainly on a price to earnings basis, it's pretty darn expensive. You know, I was having a look yesterday. I was having a chat with Rob about Westpac, and I was shocked to see that the banks are in the 20s, PE of 20s. You know, the market's on a PE of 22. Now, no doubt that's pushed up a little bit by the big players being CSL and Afterpay, which are skewing it a little bit. But you know, historically, the Aussie stock market's traded at around about 14, 15 times. So just on a PE basis, it is expensive, and it does give me worry. But I am a perennial bear, so that's par for the course for me.
Well, you're the opposite of me, as you would probably know.
Well, I was going to say, on the flip side, you know, it's not usual to have interest rates at essentially zero globally.
That's right.
So if the cost of capital is essentially nothing, well, you know, asset prices tend to go up in those sorts of environments until we get inflation, and then it's a whole new game.
Well, I wouldn't say I'm as technically committed to the stock market as you are, but I do have the view that I often use rules of thumb, which historically have worked.
Yeah.
And one of the rules of thumb when I was young and investing was if a company's PE was 20 and the interest rates were 6%, I said, well, why am I taking something that's giving me approximately a 5% return when I get a safe 6%? Now, we know interest rates are so low, we can go to 30, and that's a 33, say, that's 3% return on a company that's got a PE of 3, but interest rates are still 1. So that's the big difference to me, and that's why I'm prepared to be optimistic at these elevated levels.
Yeah, I mean, look, we've been pretty tight on our average cost of capital now, on our cost, you know, the weighting discount that we've given. And traditionally, we've put it at about 10% so that we get a significant margin of safety before we invest in a company. We want to make sure that the companies we're investing in are significantly cheaper than what we think they're really worth. Yeah. But, you know, it was about 6 months ago, we had a conversation. I said, you know, maybe it's time to move it down to 5%. If interest rates are 1, then, you know, 10% is maybe a little bit irrational. Perhaps it's inappropriate. Look, the problem with trying to pick macro themes and time the market, and we really are. You know, once we start talking about, you know, low interest rates pushing up price earnings multiples, you know, we really are drifting into the realm of trying to predict short to medium term outcomes. I don't love doing that. Maybe it's because I'm boring.
Well, maybe because you don't have hundreds of thousands of people asking that question all the time, and that's the reason why I do it. But I totally understand why you have those kind of cautious views, because you're managing other people's money.
Yeah, and the truth is, it's not such an issue for me, right? If I was looking to build a portfolio of 100 stocks, and I had to go searching for that value because I'm forced to buy more companies, well then perhaps I'd have to take into account, you know, the low cost of capital at the moment. But I'm only looking, you know, if I find one idea a quarter, if I find one really good idea every 6 months, I'm plenty happy. Yeah. I'm plenty happy. So, you know, we set the bar pretty high in terms of, you know, how cheap a company has to be relative to what we think its intrinsic value is. Yeah. And so, you know, you're right. At some point in the future, perhaps if circumstances change, you know, we'll change our average cost of capital. But, you know, I'd much rather be overly conservative than the opposite.
Okay. So, Michael, is there anything else you think, someone who's never heard of Collins Street Asset Management before and your fund, is there anything else you think they need to know?
I mean, we're a wholesale fund only. So at the moment, if people are interested in investing in us, they have to qualify as wholesale. It's not especially hard. The main ways people qualify, or the main ways we tend to see is if they've got more than $2.5 million worth of assets, they would qualify. You know, if you're investing through a super fund and you're over 50, a lot of people in Melbourne and Sydney would qualify, you know, just from their home. The alternative that we most often see is if people are investing at least $500,000 into an investment, they would again automatically qualify. I suppose if someone's uncertain, they can always give us a call and we'll walk them through the process. Yeah, we're a wholesale-only fund, and we're also, as you pointed out, we're not traded on the stock market, but we do have ongoing pricing. We don't calculate it because that would be a little bit subjective, you know. Yes. There's some risks there if the same people who are getting paid for the effort are also telling you what the value of the share price is.
And there are some people who do that.
Yeah, there are. So we've outsourced everything to third parties that we can. We are priced monthly, so each month we'll send out we'll put out a notice, and our investors will see what our unit price is, and they can measure it against what they've done. We make that available on our website. And any clients who want to come in or any clients who want to take out their money, as long as they get us the application during the month, at the end of the month, we'll strike that line in the sand, and they'll either come in or exit at the beginning of the following month.
Great stuff. And one last question, just tell us about your fees.
Yeah, so our fees are a little bit different to market standard. What we've done is, we've taken a lot of feedback we got from our early investors and from our previous life, and we've put in a system that we think really tries to align our interests with our investors. So rather than charging a fixed management fee, we have zero fixed management fee. If we do perform, we are entitled to performance fee only. So we are entitled to 25% of performance, which of course throws up some interesting circumstances. Obviously, if we do well for our investors, we do well for ourselves as well. But in circumstances like 2018, when the market was down 8-ish% or 9%, we actually were one of the only funds in our class that generated a positive return. It wasn't huge; it's about 0.5% or so, and we didn't get a fee because again, it's about aligning our interests. Our clients, said, we're happy to pay you well if you do well, and if not, we think there should be some sort of consideration there. It takes me back to one of my early conversations. Before I launched the fund, I went to meet a client of mine, Peter. Also Peter, different Peter.
Well known.
Yeah. And it was right at the bottom of the GFC. So, the market was down 20-25%. And, we were down about 5%, 5-6%. But I thought going in, we beat the market by 15%. This is going to be a wonderful conversation. I'm going to get, pats on the back and introductions, all of his friends and, top-ups galore and, ticker tape parade, whatever you imagine.
Yeah. You are a very dramatic kind of person, aren't you? Ticker tape parade.
Well, look, I beat the market by 15%. I deserve a ticker tape parade.
That's true, you do.
So I turned up, and the conversation was all around, why did this position not work out? Why did that position not work out? Very, very negative. And I said,
very
Peter,
granular too,
Peter, what do you want from my life? I said, the market was down 20%. We're down 5%. Relatively speaking, we killed it. And he said something to me that stuck with me. I think it was very insightful. I don't know if it was on purpose or not. He said, Michael, I appreciate that you're not down 20%, but I can't eat relative returns. So when we launched the fund, we launched it with those sorts of comments in mind. And we said, you know what? If we don't perform, we don't get paid. Which is good for two reasons. Number one, it aligns our interests with our investors, but it also shows that we're backing ourselves as well. We're not asking you to back me and have faith in me, and I don't have faith in myself. I have full faith in myself, otherwise we couldn't do it. The process, not myself. The process, my team. Thank God I've got good people around me. And so that's a little bit different, but it's worked for our investors, and thus far it's worked for us as well.
Yeah, great stuff. Well, one last question. If people want to check out your website, what's the website they check out?
It's www.csvf.com.au.
Thanks for joining us.
Thanks for having me.
That's Michael Goldberg, MD of Collins Street Asset Management.